Hi, I'm Brett Manning, Product Manager for Plaid Credit Solutions. Thanks for joining me today to dive into a new way to measure credit risk with the Plaid LendScore, a first-of-its-kind risk score built to reflect the financial lives of today's consumers. We're launching it today in beta with a waitlist, so make sure you sign up now. We'll talk about the limitations of traditional credit scores and how Plaid designed a smarter and more predictive model. Then we'll show you how our score works and answer some questions lenders might be asking about it. Before we get into the product, let's talk about the challenges that lenders are facing today. Technology has changed the way consumers manage their finances. They're increasingly receiving income from gig work, using services like early wage access and buy now, pay later, and leveraging a variety of apps to budget, save, invest, and borrow. Lenders need new data and insights to assess credit risk with greater precision. They need to balance increasing approvals and presenting competitive offers with managing risk, and to do this successfully, they need to improve decision-making accuracy. Traditional credit scores are still a crucial tool for risk assessment, but they are limited in three important ways. They focus on folks who already have exposure to traditional credit. They miss out on actual cash flow and savings. And they're missing behavioral signals that account for all the different digital tools that consumers use to manage their finances. What if you could capture a more dynamic picture of what is happening right now in an applicant's financial life? Plaid is uniquely positioned to solve this problem given the depth and breadth of our network, with 800,000 daily connections by 1 in 2 US consumers across 12,000 financial apps. This is why we decided to build our LendScore. We listened to our lending customers and learned that they need better data to enable profitable growth and future-proof their loan portfolios. Because we have a unique data set, we can deliver a score that is complementary to traditional credit scores, delivering an average of 25% lift in predictive performance in targeted risk tiers. We already have best-in-industry conversion for bank account connectivity and FCRE compliance through the Plaid Check, our consumer reporting agency. So rounding our offering with a comprehensive set of insights condensed into an easy-to-use score was an ideal next step to support lenders. We wanted to ensure that our credit product suite had a holistic set of solutions to meet lenders where they are. Now, let's talk a bit about how our model works and why it's different. There are two main sets of explanatory variables used in LendScore: real-time cash flow data and Plaid network insights. First, that real-time cash flow data. We looked at 180 days of data, building hundreds of attributes that help us understand how an applicant is managing their money, ranging from average account balance, income, debt payments, essential and discretionary spending, and more. Cash flow makes up about 80% of our score model. Second, the network insights, which make up the remaining 20% of the model. This is a highly predictive, orthogonal, proprietary data set that comes from the nearly 1 million account connections happening every day across the Plaid network. So how this works is, when a borrower uses Plaid to connect their bank account to a different app and service, we can see that activity across our network. We then build insights and attributes based on the types of apps someone is connected to within a certain time period and how long they've been active on each of those services. This adds another layer of intelligence to help lenders understand how risk is changing for the borrower. These behavioral insights have never been used before in lending decisions, and you can't get them anywhere else. We see more direct connections to more financial institutions than any other open banking provider, and the scale of this dataset unlocks unique and profound insights into how risk is changing for a borrower in real time. This combination of cash flow data and connection activity is more predictive and inclusive. For example, some of our most predictive signals are things you'd expect. Having more lending connections is bad, as are higher debt payments, just like you'd see on a traditional credit file. Whereas wealth management and personal financial management connections and higher bank balances are good, and this is something that you can't see in a traditional credit file. But the real value comes in the combination of these factors. Crypto connections by themselves are good, but combine those with gambling transactions and we see strong negative impacts. I bet you're wondering how we took all of this data and distilled it into a single score. The sample for development of our model is made up of both attributes and credit bureau data. We started by analyzing consumer permission data from over 1 million borrowers across the Plaid network, representing nearly 1 billion transactions. Then we worked with a traditional credit bureau to match these individuals against new credit lines on consumer files. Based on the combined dataset, we built a model that predicts risk using our attributes. Our aim is to break default, but defaults in the real world are messy and complicated, and not specific discrete events. For example, a borrower might be very far behind on payments but then catch up quickly, or they might constantly say one payment ahead of charge-off. So we had to choose the right line and build our target variable from it. Specifically, we chose 90 days late within 1 year. for each new trade line between September 21 and June 23, a period where the bad rate was stable, avoiding any instability from the COVID period. We used a broad coverage for trade lines, with the majority being credit cards, personal loans, and auto loans, and the minority being other loan types. This ensured we had a score that will work across a significant number of lending applications, although focusing on unsecured lending. All that sounds great, right? But what does this mean for lenders? We tested our model across credit cards, charge cards, personal loans, auto loans, for a number of consumer credit profiles. We found that LendScore can differentiate risk better than traditional credit alone across a wide set of borrower types and use cases. For example, we saw a lift of more than 40% for subprime consumers for credit cards, and a lift of almost 70% for higher quality consumers in personal loans. For unsecured personal loans alone, that could translate to a 3 percentage point drop in average APR for US borrowers, potentially saving Americans over $8 billion a year in interest payments. At the same time, saving lenders $1 billion a year in credit losses. Even among prime borrowers, using LendScore could help increase originations by 10% while maintaining strong risk controls. And the great thing about LendScore is that it's a complement to traditional credit scores. LendScore is orthogonal to traditional data, meaning we can provide new, independent data that offers incremental predictive power versus just using a credit score alone. And unlike other alternative data, our network insights provide differentiation across the credit spectrum. I want to take some time to walk through this chart because it's a little bit gnarly. Each row represents a segment based on traditional credit benchmark. We then look at how LendScore differentiates risk across each segment, comparing borrowers with scores in each quantile of the LendScore with the average for that row. So, for example, this shows that for super prime segment, the top row, borrowers with a LendScore of 1 to 20 are 3 times more likely to default than the average for super prime borrowers. Whereas borrowers with a LendScore of over 81 were 50 times less likely to default. Or, to put it another way, those with the highest LendScores were 144 times less likely to default than those with the lowest in the super prime bucket. And we see the same pattern across the credit spectrum, with a high LendScore indicating 20 times reduction in risk compared to a low LendScore in the subprime space. Identifying hidden risk at the top of the credit spectrum is a huge advantage for lenders in this competitive segment, but the LendScore proves just as useful for near-prime and subprime segments as well. Let's take a quick look at how consumers share their data and what information is available in our API. Consumers can easily connect their account in the application flow to share their data with a lender. Used by 1 in 2 US bank account holders, our familiar and secure account linking experience delivers conversion rates of up to 80% in lending flows, far exceeding industry averages. Built-in returning user experiences make it faster and safer to connect accounts, reducing friction and boosting conversion even further. Once a borrower connects their account, lenders can see their LendScore along with adverse action reason codes for FCRA and ETOA compliance, and a summary of the latest trends in cash flow and network insights. So what you're seeing is a score that not only predicts risk more accurately, but also integrates easily into a lender's workflow and provides transparency that credit teams can trust. So that's the LendScore, a smarter, more predictive, first-of-its-kind credit risk score built on unique data. Our score helps risk teams make smarter decisions to reduce defaults, and it helps product and data teams innovate quickly and efficiently. LendScore rounds out Plaid's credit product suite by offering a proven, production-ready, and scalable solution that gives lenders the ability to spot hidden risky borrowers and identify missed opportunities among underserved groups, all in a single metric. I know you might have some additional questions about the product, so let's go through some that lenders may be thinking about. What does integration look like? How about the timeline and the workflow? How can lenders get started? LendScore is a market-ready solution that lenders can get started with quickly, no matter the scale of their internal resources. We can start with the retro, where Plaid will pull data based on your existing traffic to build a retro dataset. We'll combine your loan performance data for that sample with our insights and build a custom analysis of our score and attributes to help you understand the impact. How is consumer consent handled? Consumers consent to share their data for this purpose via Plaid link flow, and we ensure transparency every step of the way on how the data is being used. As a regulated CRA entity, compliance and consumer protection are top of mind. We've established direct connections with over 12,000 financial institutions to ensure reliable access and comprehensive coverage. How do we validate model performance? We know it's important to follow robust model governance processes when building credit models, so we made sure that we crossed our I's and dotted our T's. That means that we carefully considered the sample we used to build the model, distributing our 1.44 million lines across a broad set of trade lines, with the majority being credit cards, personal loans, and auto loans. We then employed gold standard cross-validation and out-of-time testing to ensure that our model predictions were robust and reliable. We also took our model and attributes through rigorous fair lending testing with industry leader Fair Play, verifying that the predictive power we're seeing is not a result of unintentional bias in any features and meets the requirements of the COR and other fair lending regulations. Then, on top of our rigorous internal model validation process, our friends at 2OS did a deep dive on our model and features to make sure there was nothing that we'd missed for our initial launch. And now, we're putting in place ongoing monitoring to ensure that LendScore continues to do its job even as the economy evolves. How often will the model be updated? Well, we're planning annual updates for the score with new attributes and more recent data to ensure that we're always capturing the latest consumer behavior. And each update will include a new version with a full set of fair lending testing and model governance processes. If you have any more questions and you're a current customer, you can reach out to your Plaid account manager. The waitlist is now open, so make sure you sign up. Waitlist members will get exclusive updates, early insights, and will be the first companies that are selected for access. Thank you again for joining us today, and we're looking forward to transforming the future of lending with you.